The stock market has rallied on hope that the Federal Reserve will pivot in time for the US economy to avoid recession. But recession may be here. The Federal Reserve is slamming on the brakes to stem inflation, with another 75 basis point rate hike as expected. A federal-induced recession now seems to occur likely. Much of the debate is focused on whether a downturn will start this year or 2023. Increasingly, the most timely indicators suggest a recession is near. While even a shallow recession could cost over 1 million jobs, a near-term growth deteriorate may not be the worst outcome. It would help ease the biggest inflation outbreak in decades, letting Federal Reserve rate hikes end more quickly. That might avoid a more severe recession that hit corporate profits and provokes a further sharp sell-off for the S&P 500. Yet under any economic scenario, inflation fears won't subside without more pain from the Fed. The unemployment rate is bound to rise. That could come abruptly or last into 2024 as the Fed's low probability, soft landing projections envision. So stock market investors should be realistic about prospects for a sustainable near-term rally. So, welcome to our channel where you are watching about Federal Reserve recession and what's in store for the US economy. So, are you ready? Let's begin.
Jobless claims. Recent economic data has sent up no shortage of red flags. Initial jobless claims rose to 251,000 in the third week of July. While historically low, claims have jumped about 50% from March lows. Some prior recessions have started after just a 20% rise in claims. Meanwhile, housing starts have plunged 14% over the past 2 months amid a spike in mortgage rates. Inflation-adjusted consumer spending fell 0.4% in May, more than erasing a 0.3% gain in April. The Institute for Supply Management's manufacturing survey showed new orders suddenly turned negative in June. Most economists have been bumping up the odds of recession. Yet there's one big reason that many think it's still a ways off. The June jobs report showed employers added a stronger than expected 372,000 jobs. If job and income growth really are still robust, the economy probably won't give way quickly. Job market, is it weaker than it looks? Yet a closer look is in order. Recall that the Labor Department's household survey showed that the ranks of the employed fell by 315,000 in June. The survey shows 347,000 fewer people working than in March. Federal taxes. This may be one of those times. An IBD analysis of Treasury inflows finds that the growth rate of federal income and employment taxes withheld from worker paychecks has been sliding sharply. Growth in those tax receipts over the 10 weeks through July faded to just 7.5% from a year ago. That's down from about 12% through mid-May. The tax data suggests that aggregate labor income, reflecting gains in wages, hiring and incentive pay across the economy, has hit an inflection point. Labor income is now shrinking in real terms. The experts, who track tax withholdings for investors, begin to spot such inflection points. They told IBD that they are also seeing a nasty reversal at odds with the supposedly strong job market. They observed and said that they are expecting the 370,000 jobs gained in June to be revised away in the future. The Federal Reserve's most anticipated recession in history may be coming.
When questioned to Federal Reserve officials what about all those job openings, they said they are not aware of a time when we've had 2 job openings for every unemployed person. Job listings have since fallen by 6 lakhs, or 5%. But the picture has only changed on the margins. The latest Labor Department data shows 11.3 million openings versus 5.9 million unemployed. Fed officials aim to cool the economy enough to reduce excess job openings and dampen wage growth, without provoking significant layoffs. Yet a new paper from the Peterson Institute for International Economics, co-authored by former Treasury Secretary, paints those job openings in a different light. The high number of openings only partly reflects the level of economic activity. A high level of job switching has also played a role. Another more troubling factor, the paper argues, is that the economy has become less efficient in matching workers to jobs. If true, the labor market may be even tighter than the 3.6 unemployment rate, near a half-century low. That finding yields two unwelcome conclusions: the natural, or non-inflationary, rate of unemployment may be more than a percentage point higher than the Federal Reserve thinks. And bringing down the ratio of job openings to unemployed workers likely won't happen, without a substantial increase in the unemployment rate. Hope for a soft landing. The price of oil and other commodities has already fallen sharply. That could turn modest declines in real spending into modest gains. If inflation comes down enough and the job market weakens just enough, the Federal may slow, then pause rate hikes later this year, the thinking goes. Expectations of a federal pivot have sparked broad-based stock market gains this week. Yet even in a soft landing scenario, the near-term outlook for the stock market may not be particularly bullish. In our base case for a soft landing, we think stocks will be largely range-bound with continued elevated volatility as investors assess the durability of economic and corporate profit growth in the face of aggressive federal rate hikes and declining real consumer incomes, according to Chief Investment Officer Americas at UBS Global Wealth Management. Historically, equity bear markets typically only end when the Federal starts to cut interest rates or the market begins to anticipate a re-acceleration in business activity and corporate profit growth. Both of these potential upside catalysts are unlikely to materialize in the near term.
S&P 500 earnings outlook. If the job market and inflation soften enough for Fed rate hikes to end early, what will that mean for corporate pricing power and profits? In Wilson's view, the counter-argument that S&P 500 profits will hold up implies that inflation is going to stay hot and pricing power is going to remain robust. To Wilson, that seems unlikely in an environment where we're already seeing demand destruction and consumer confidence is tanking. Experts say analysts have yet to cut their estimates that S&P 500 earnings will rise about 10% over the next year. In their view, stocks could fall another 10% if APE's growth is cut to zero. Most Americans think the US is in a recession. It's no coincidence that the S&P 500 hit at least a temporary bottom in mid-June, just as the 10-year Treasury yield was spiking close to 3.5%, a level last seen in 2011. To a large extent, the S&P 500's 24.5% decline from the peak to trough reflected a compression of valuations, as investors used a higher risk-free rate, the 10-year Treasury yield, to discount future earnings back to the present. Be sure to read IBD's Daily Afternoon The Big Picture column to stay in sync with key market trends and learn what they mean for your trading decisions. With the 10-year Treasury yield easing below 3% lately as investors brace for a slowdown, or worse, stock valuations have recovered a bit. Yet in a soft landing that pulls recession and a significant hit to employment, Treasury yields may hold near current levels. That means there may be limited additional relief on the valuation front even amid a softer earnings outlook. By contrast, even a moderate recession could spur the Federal Reserve to cut its key interest rate all the way back to zero, as per experts. That would help to reverse the liquidity shock of recent months and reinflate stock multiples. Bear market news and how to handle a market correction. In late 2018, the last time the Fed was hiking with both fists via rate hikes and shrinking its balance sheet, all it took was a 20% S&P 500 drawdown to provoke an about-face. By fall 2019, the Federal Reserve was cutting rates and buying bonds again. The market still thinks that weak growth prints are going to get the Federal to back off. But inflation has really tied their hands. In a June 18 report, The Economist made a Q4 recession call. They expect a one-mandate Fed, having effectively ditched its mandate to maximize employment so it can wrestle down inflation, to tighten financial conditions until the consumer and job market roll over. The economists see Fed rate hikes at each of the next 5 meetings, with a 75 basis point move. They expect a 50 basis point move in September, followed by quarter-point hikes in November, December and February. A pause could come sooner, but that will depend on inflation. It being noted that Federal Reserve has said that a pause in rate hikes could come once inflation subsides to a 2.5% to 3% annualized rate. That equates to monthly inflation readings of about 0.2% to 0.25%. It has been expected that the Federal Reserve will continue quantitative tightening, letting bonds run off the balance sheet as they mature, until policymakers start cutting rates in October 2023 to avoid a deeper recession.
Looking for the next big stock market winners? Start with these 3 steps. Federal Reserve policy lags. It's finally clear that inflation has peaked and is now on the way down. That's certainly feed for a short-term stock market rally. But there's no reason to think that a peak in the CPI necessarily means a bottom for the S&P 500. The US economy is entering a tunnel, not seeing the proverbial light at the end. A range of US financial conditions indexes, from the Chicago Fed to Goldman Sachs, still show conditions across equity and bond markets are only approaching neutral, after years of easy money. That's partly because of time lags before Federal Reserve policy hits the economy and partly because the Fed's policy rate, though rising fast, has yet to reach a level that economists see as restrictive. Plus, the Federal Reserve only just began shrinking its balance sheet. So far, it's down about $36 billion, or 0.4% of the $8.9 trillion total. But the pace will quicken to as much as $95 billion per month in August. While gas prices have tumbled from their peak and goods prices have come down, non-energy services inflation accelerated to a 30-year high 5.5% in June. That covers 57% of consumer budgets, including categories like rent and medical services that are linked to elevated wage growth. It may take more time and harsher medicine for the Fed to sufficiently dampen those price pressures. Or maybe it will happen faster than expected, if we really are on the point of transition of a Fed-led recession. Either way, the economy and job market are in for a tough period. Stock market investors aren't likely to be completely spared.